Good evening, folks. It is Thursday, October 27th. I want to speak briefly about the day that we had today and the importance of sticking with your strategy and trying to take it the same way every time. What you're looking at here is the YM mini, the Dow mini futures, and as you can see, it was basically straight up all day. We opened up, we drifted off, had a pullback, nice pullback here. And depending on your strategy, this might have been an opportunity for you to get long, and then we proceeded to go higher over the course of the rest of the day, selling off into the close as folks like ourselves trimmed positions, got out of things to make sure that we didn't have any overnight risk. But the reason that we're coming to you and talking about this is we wanted to point out, let's just say that you are employing a counter trend strategy, and you have to remember that as we were looking at this first thing this morning, it wasn't obvious, given how far we had run up, it wasn't obvious that this wasn't going to be a rollover. What you're looking at here is this forms when you take out the low of the high bar. So for example, you'll see this indicator form. It's our own indicator. You'll see it form each time if you have it on. Each time, in this case, the low was 12,116. So assuming that the high wasn't taken out by this next bar, when the low is taken out, you will have this signal form. So it forms, and at that time, we were up, I think, over 200 points at that time. It really looked like that might have been a good time to get short for a counter trend trade. But let's just say, for the sake of saying, that this is your strategy. You're a counter trend trader. You like to trade against highs, and you will get short on this kind of signal, and your stop will be a tick above the high. Which is obviously put in by this bar, and then by this bar, and then by this bar. So let's say you took each one of these in one contract only, and let's just see what your results would have been. So starting out with the first one, you would have lost here, right? You would have gotten short at 115, and you would have gotten out at 139, which would have resulted in a loss of 24 ticks. Here you would have lost 21 ticks, and again, this is assuming that you didn't scale out or scalp your way out of it and take any off when it gave you a few ticks in your direction or anything like that. Here you would have lost 21 ticks. Here you would have lost 15 ticks. And here obviously you didn't get stopped out. Where you got out is completely up to you, but you didn't get stopped out. So what you would have ended up with the if everything played as we're saying, you would have lost a grand total of 60 ticks, which in the YM is a total of $300, not including your commissions. So now you're out $300, you're out 60 ticks, and you come up to this trade. What's really important is, unless you have rules that say you can only have 3 losses in a row or 3 losses in total for the day, or something in that family, whatever this number is, you have to take this trade the exact same way, right? So you take this trade at 199, and depending on where you got out, let's say you got out at 56 because this is a pivot level and you didn't think it could get through, so you get out at 56. If everything else had been done the way we framed it, you would now be down a grand total of 17 ticks, right? Now, let's say that you were willing to hold it and you moved your stop down, and now you're just sitting with it. And let's say you held it all the way down to, one of my favorite things to do is to get out a few ticks in front of a big round number, which in this case would be 12,100. So let's say you got out at let's say you got out at 12,120, right? So now all of a sudden you would be up 19 ticks, having made 79 ticks on that trade. And you not only have you recouped your losses for the day, but you are now up. Now the point is this: it's not necessarily that you're always going to get this trade, that this is automatic, and if you're up this much, this is always going to happen. The point is, even if you had, like we said, taken it off at 12,156, or if you're taking it off at 12,176 because you got nervous and whatever, at that point you would only be down 37 ticks if you got out at 12,176. And more importantly, you would have taken your trades the exact way that you were supposed to every time, and ultimately that is what's going to allow you to be successful as a day trader, swing trader, whatever kind of trader you are. And again, clearly it would have been more profitable to have been a trend trader today and taken this signal off the top here in the direction of the trend, or this signal here, or this breakout here, or the breakout of this box, or this long signal here. But there was no way to know that as it was occurring, right? There was no way to know how this was going to respond right here, right? There was no way to know that it was going to continue higher. You had to take your, just as you would with these counter trend trades, you had to take your shot, pay your money and take your chances. But the most important thing is using your stops, and then along with that, making sure you stay with your program and trade your program the same way, because assuming that you have back tested it and forward tested it and know it to have be a high probability trading system, or even if it's not high probability in terms of wins, if it is profitable over the long haul and you know that and you're comfortable with that, you have to stay with it and not start doing things like trying to get your money back and all that kind of stuff. You have to stay with your program and let it work for you. That's it. We just wanted to highlight that, and this seemed like an opportune time to bring that up and talk about it. So we thought we would. We will speak to you soon. Hope things are going well. Good luck. Good trading.